This video is for educational purposes only and should not be considered financial advice. Using fair value gaps with the 4 EMA. Practicing ICT concepts can be hard, especially when you don't know which fair value gap to take. One thing that can help make it easier is to use the 4 EMA with a shift of 4 to confirm the move. In this video, we will show you how to use the 4 EMA to confirm that the fair value gap is legitimate and be able to feel confident about your entry. We're not going to go into detail about fair value gaps in this video because ICT has many videos on what they are and how to use them. Here's his introduction to fair value gaps on his website. What we are going to cover is how to build your confidence in entering your trade by using the 4 EMA with a shift of 4. Here's what a fair value gap looks like. Price moves up, and then there's a break of structure. Then price moves to the upside and then creates a gap between this level and this level. And we will draw that out as a rectangle. Then price moves into the fair value gap, usually to the 50% level, and then moves to the downside. And when we're using our 4 EMA, the 4 EMA follows price closely. And then when price breaks the 4 EMA, after breaking structure, and then also going to the 50% level, that is where we enter. So our entry is when price closes below the 4 EMA with a shift of 4. So this would be our 4 EMA with a shift of 4. This is our fair value gap, and this is 50% of that fair value gap. Now sometimes price will do movements like this, where it doesn't break the structure and then it breaks structure on a second impulse. And what you'll want to watch for is the fair value gap that's created right in here. And you'll want to go to the 50% of that fair value gap. Price moves back in and then moves to the downside. And you'll want to watch the 4 EMA, and sometimes it will cross the 4 EMA already, and that will give you an entry. And other times what it will do, it will go above the 4 EMA and then it'll close back below the 4 EMA, and that will be your entry. Let's look at the charts. So here we see price has gone up and then drops below a swing low. That is your break of structure. Price moves back into this fair value gap and it hits the 50% level. Then it crosses below the 4 EMA. That is where you enter. Price continues to the downside and gives you a nice 2-to-1 trade. And if you watched some of our other videos, you can use the MACD to confirm your breaks of structure. You see here's a swing low with a red histogram, and then this histogram that went red is lower than this one. Here's another example. We see that price rallied to the upside. It didn't break any structure. It comes back up, and now the structure is broken. We see a fair value gap, Price retraces back into that fair value gap. Then it crosses below the 4 EMA. Just like we showed in the example, price went above the 4 EMA, then closed below, and went back above again, and then closed below. And that created your entry. This again is another 2 to 1. And if you look at the other side, you can see another fair value gap here where price went to, and that could have been your cue to get out. In this example, we see price took liquidity on this downside move. Then price broke structure, created a fair value gap while it broke the structure, then retraced back into that fair value gap. Now, normally what you're looking for is a move to 50% of this impulse leg. But because of this fair value gap, you can be confident that price is going to leave this open until later. And what really gives you the confidence, which is why we're doing the video, is when price crosses above that 4 EMA, you can rest assured that it's going to continue. Then it continues to the upside, and if you feel like price needs to move down to get rid of this liquidity void, you can get out when price reaches this order block, this last up candle before the down move. 50% of this order block is where price reached to, and then it went down, filled this liquidity void, but then it continued back to the upside to take this liquidity that was above here. In this example, we see price has a strong move to the upside. It moves down, does not break structure yet. Although you could say this is a swing low, this is a swing low, but if you're looking for confirmation on the MACD, you don't get it. So then price comes back here. This liquidity is created. It takes that liquidity, also taps this order block. Then price breaks structure right here. Comes back up into this fair value gap, and then crosses below the 4 EMA. That is your entry. When price closes below the 4 EMA, even though all of this looks very suspicious and very crazy, you can have confirmation that your trade is going to pan out. Once you see this break of structure, a move to this fair value gap, and then a close below the 4 EMA. Even though price moves back against you, you still have to just hold out until it moves down to the downside. Price also creates a second entry when this break of structure occurs. It retraces back into this fair value gap and then closes again below the 4 EMA. And you could also pyramid your trade off of that move, as we see that there's liquidity over here that price is reaching for. We hope you've enjoyed our video. Please like and subscribe for more videos like these. Thank you for watching.